Welcome back to Vantage. Now, when you look at the world today, there are certain big themes that we're focused on. Going to net zero, energy security, efficiency, and how we do things more productively. My next guests are at a fund which is looking to deliver on all of these themes. It's a fascinating journey in terms of, where they've come from and the technologies and the things that they're investing in. Let's go take a look. Welcome back to Vantage. Thank you for joining us. Energy efficiency, sustainability is a really huge theme out there. I am delighted to have two representatives of the SDCL Energy Efficiency Income Trust with us. Who are going to talk to us about its aims, how it differs from the majority of the other renewable energy infrastructure sector on the AIC. Tamsin, Ben, welcome to the show. Maybe you could just start by introducing yourselves.
Thank you, Neil. I'm Tamsin. I'm one of the fund managers of SDCL Energy Efficiency Income Trust. We call it SEEIT. And this is Ben, my colleague.
Morning, Ben Griffiths, Managing Director at SDCL and the other fund manager at SEEIT.
Okay, welcome to the show. Tamsin, maybe you could expand on, the trust, its aims, what makes it different.
Of course, yes. So SEEIT is a FTSE 250 investment company that invests into the most valuable energy resource, which we think is efficiency. So SEEIT invests into commercial projects that are either reducing cost and improving the productivity of energy. There is so much waste in the supply and demand of energy. By reducing it, the end customer gets energy that is cheaper, cleaner, and more reliable. And SEEIT gets long-term contracted revenue from creditworthy counterparties.
How many projects roughly are you invested in? How diverse is the portfolio? Maybe you can just give us a flavour of that.
We IPO'd in 2018, and since then we've grown to be a £1.5 billion enterprise value portfolio that is fully diversified across around 10 countries with 50,000 end users, approximately 50 projects, and a number of different technologies. So despite a gross NAV return of about 9.4% and actually considerably more if we were to maintain the current levels of debt that otherwise amortise down. We're trading at about 40% discount to NAV, which means that it's a really attractive entry point. So a new investor would be looking at around about a 12% dividend yield.
Okay. And is that, so I'm going to ask you what makes you special, what makes you different, right? Is it the yield? What's, in your view, what's made you stand out?
Yeah, of course. So notwithstanding that particularly interesting value proposition, so I think we get compared a lot to some of the renewable infrastructure funds out there and investment companies out there. And I can understand why, because we're all reducing carbon emissions and it's everything is critical. But actually, I think a lot of the ways that our returns are driven are quite different. So one big one is energy prices. So SEEIT doesn't invest in merchant energy. So it has got no unmitigated exposure to merchant energy prices, which means it's not subject to the same regulatory environment and competitive market that some of the large-scale renewable energy funds are. The second thing is the subsidies. So there are a couple of exceptions, but on the whole, SEEIT is not dependent on government subsidies. All of the investments are commercially viable investments, regardless of the political tailwinds. So it's a fairly young portfolio. We achieved scale really quickly, but a lot of the investments are quite new, and they have long-term investment plans to unlock platform value, to increase efficiency, and also to invest into the high growth projects within it. And then finally, we built the portfolio with fairly low levels of gearing, which means that despite the current environment, we have been able to continue to fund those growth investments.
Look, focusing on energy efficiency as a sort of thematic area, what makes energy efficiency so important in the race to net zero? And I'd love to understand, what some of the sort of common misconceptions you hear in this area and what gets overlooked in terms of our pathway to a carbon neutral future.
So energy efficiency means using less energy to achieve the same outcome. It saves money and it reduces carbon. And that carbon reduction is absolutely critical in the journey in the path to net zero. I don't know if you're aware, but actually 70%, that's 70% of the world's energy is wasted, whether it's from the point of production through to the distribution or the end user in their homes or in offices. So I think quite a lot of people do understand that there is energy lost, but I think the bit of it that they don't understand is the shameful extent of it, the scale of it. So we can't get to net zero without reducing loss and waste. And it happens to also be much cheaper than building solar farms or wind farms. So it's something we've absolutely got to do. The IEA's net zero by 2050 scenario states that by all of the emissions reduction needed by 2030 can be delivered by energy efficiency when rolled out with rapid deployment of solar and wind. So both things are needed, but we can't get there without energy efficiency. And as for why it's overlooked, to be honest, I'm not sure that it is anymore. I think this is increasingly at the forefront of policymakers' minds. I think it's increasingly considered an essential part of how we're going to get to where we need to be. Because frankly, we need to find the cheapest and fastest way to get to net zero.
Yeah, no, I can see it. And I can see multiple strands in that, because it's not only achieving the goal of net zero and the sort of the impact on climate, but energy security is a really big issue. And in a world where, actually inflation's becoming, increasingly a focus, anything that helps drive down the cost, I think is something which is useful. Okay. So how is the portfolio currently performing this year? And I'd love to understand which technologies seem to be sort of leading the charge in terms of performance.
I'm glad to say that the portfolio's been performing well, is in line and actually just slightly ahead of expectations. And it's this performance that drives the cash flows that the portfolio generates. And it's those cash flows that underpin the dividends that we pay our shareholders.
Yeah.
In terms of technologies, and this is one of the strengths, I think, of our portfolio. We have a very diversified portfolio of established technologies, whether it's high efficient gas turbines or CHPs, behind the meter solar, EV charging, biomass generation, or even LED lights. And that really means that we are mitigated against single technology risks across the fund. As to technologies that are leading the charge, we're particularly excited in a couple of areas at the moment, in particular in behind-the-meter solar and storage. We own Onyx Renewable Partners in the US, which is one of the leading commercial industrial developers for behind-the-meter solar and storage. So we're building out solar behind the meter, delivering power direct to the customer that is using that technology. And so far this year, they are setting all sorts of company records. For example, they have an annual target to hit 70 megawatts of sites to notice to proceed, which means the start of construction. They actually met that at the end of September, so 3 months ahead of budget. And they're really going from strength to strength in that sense, and there's a lot of excitement there for what the future holds. And very similarly, just quickly, in the UK, we have a portfolio of ultra-fast electric vehicle chargers. So we work with a company called the Electric Vehicle Network, or EVN, and they do a very similar role to Onyx themselves in terms of developing those sites and building and then operating. And so far, at the last count, we had about 28 sites operational across the portfolio. And again, that's a technology where there's a lot of interest going forwards, and we expect that to continue.
Okay, that's good. Then I love the illustrations you give with the sort of real technologies. Now, strategically, I mean, there seems to be a lot of opportunity, but given the fact that equity markets effectively shut for investment trusts, given the sort of wide discount to NAV we're seeing across the broader sector, how do you guys think about that in terms of its impact for growth, and what is SEEIT's strategy around navigating the current environment to enable growth within the portfolio?
Yeah, it's a very timely question, and given where we are in terms of the market circumstances, we're very focused on ensuring that we're putting capital to work in the right place. And what that is leading towards is investing in the existing portfolio, what we call organic investments across the portfolio. That's really where we're focusing at the moment. And, you know, this highlights one of the key differentiators for SEEIT, in my opinion, in terms of we don't just look for investments and businesses that we can invest in and they'll keep on doing the same thing year after year, 5, 10, 20 years. We also, you know, a lot of our projects are platforms that deliver growth opportunities, these organic opportunities. So an example of that, in upstate New York, we own a company called Red Rochester, and that's a district utility business. So we provide about 16 different energy services to commercial industrial customers on a business park just outside of Rochester in New York State. Anything from steam, hot water, chilled water, different electricity services, but also wastewater services. We provide those to all those customers, and we're partway through and nearly at the end of a $85 million capital project to build a cogeneration plant. And what is that? It's a high efficient gas turbine on the site that produces electrical power, but it's also recovering a lot of waste heat and generating high-grade steam that we deliver to our customers on the business park. Why? We're already doing that, but why are we doing it? It's to install highly efficient systems, so it's improving the energy efficiency of the systems on the site, and therefore reducing the costs. And our business, Red Rochester, we save those costs. And just lastly, so this is one example of where we can put capital to really, really good use on the existing portfolio. The other critical aspect of this is how we do that and how we select these opportunities given the market environment. And what's central to that is our capital allocation policy. And we make sure that where the capital is being put towards is driving and maximizing the shareholder return. And we're very cognizant, and central to that is where our share price is and the discounts. And effectively, what we're doing is ensuring that the returns that we can generate through those opportunities is at least, if not greater, and the majority of time it is greater than, the equivalent value to shareholders of share buybacks. So we're really looking to maximize NAV growth in the portfolio, but also maximize shareholder value returns.
Yeah, okay, perfect. And how is SEEIT actually, and the discounts there, so how is SEEIT actually looking to address or correct this discount? Because I'm sure that was going to help.
Yeah, so, well, as Ben mentioned, the fact that we're incredibly focused on our capital allocation policy at the moment. And that's one of the ways that we're working really hard to protect shareholder value. But there's a number of levers available to us as managers of the trust in order to try and address the discount. I think some might argue that macro factors are what will make a real material difference, but my personal belief is that it's our responsibility to continue working those levers as best we can in the meantime. So gearing management is another one. We have been fortunate to have managed to keep gearing levels well within the limits historically, which has meant that we've been able to fund the growth projects within the portfolio through our short-term RCF revolving credit facility. But of course, that's a short-term solution. In the medium term, we're incredibly focused on reducing that back down. We've committed to reducing it to between 100 and 150 million by the end of 2025, but actually much faster with a disposal. Which brings me on to the next lever that we can pull, which is, of course, partial or full disposals, or perhaps bringing in co-investors to some of our assets. Now, whilst that does help to pay down the RCF, it also goes a long way to proving the NAV, to validating the NAVs within the portfolio, which, you know, ultimately there's what we do, but there's how we're perceived as well, which has a huge impact on the share price. So proving that it's worth what we think it's worth is absolutely critical. And that can also, another benefit of disposals is that we can recycle the capital and potentially use it towards buybacks. The next lever is sort of income growth. We've always paid a fully covered dividend that has increased. It's a progressive dividend, and we have every intention to continue doing that. We've got the distributions from the portfolio that mean that's absolutely feasible. And finally, we've been supporting the marketability and liquidity. We are out on the road as much as we can. We're bringing in new shareholders, particularly in the US, but we are speaking to people and engaging as much as we possibly can.
Yeah, no, and look, but I think that you could look at your registered General Atlantic has appeared on that. I think that's great that you're starting to find. We're big advocates of there's a diverse pool of capital. It's great that sort of that kind of validation of what you're doing is so seeing through. What's the global policy environment looking for SEEIT in 2025? Are there any particularly strong policy or regulatory headwinds, tailwinds that you think you're facing?
Yeah, so we're fairly confident in this area, and we think that there's good support for energy efficiency. And fundamentally, what our projects are about cutting costs, increasing productivity, and at the same time delivering a benefit to the environment. So, frankly, those means should transcend political parties and policies. But more specifically, so in the UK, we have targets and commitments to reduce the energy demand by 15% by 2030. We also have our net zero commitments by 2050. And, we touched on it earlier in terms of the important role that renewables have to play in that part, and that solution is fairly well recognised and understood. The energy efficiency angle to that and the role energy efficiency has to play is equally, if not more important, but isn't as well understood. But that's what we're trying to do, and that's what we're trying to solve. Also, we're very cognizant that 2/3 of our portfolio is based in the US, and the upcoming change in government in the US, there's a lot of questions around different how that might impact not just SEEIT, but the energy industry. It's obviously quite early to be able to determine that, but a couple of things that is worth mentioning. There's the flagship legislation of the Inflation Reduction Act that came into force, and whether possible repeal of that. But there's a lot of commentary to suggest that that's unlikely. One, because a lot of those funds are already spent or committed, but also because a lot of Republican states have benefited from it. So that feels relatively unlikely. But I think the more important point from our point of view is that our projects existed before the IRA. They were already in place delivering those benefits before that. We're very much seeing that as an opportunity that goes hand in glove also with the fundamentals of what our projects do. We often say, if it's not economically viable for the customer, it's not sustainable. It's got to work for both sides for the long term. So, all those things together gives us the confidence that there is significant support for energy efficiency going forwards.
I found this whole conversation really fascinating. I think you've got a coalface seat, effectively, at probably one of the most important sort of areas from a thematic perspective, from a policy perspective. You get to see the technologies that are working. And as we've been talking, I could imagine, if the three of us took a road trip, I'm guaranteeing you that you'd have all kinds of interesting factoids as we're passing various stations and power lines. I'd love to hear from you. As you've come to learn about SDSCL and as you've been working there, one interesting sort of fact or story that's really stood out for you.
The fact that has really blown my mind since I joined SDCL is actually about the NHS.
Yeah.
So I don't know if you're aware, I certainly wasn't, but if the NHS replaced all of their light bulbs, just light bulbs, with energy efficient light bulbs, that between now and the end of the decade, that would save them £1 billion. Wow. £1 billion. Imagine what they could do with that.
Yeah. That's extraordinary. Ben, how about you?
Tamsin mentioned it earlier, but it's worth repeating. And I think it's the thing that hits home the most. But over 2/3 of all energy generated is lost in the world, which is pretty staggering. And energy efficiency It's the cleanest, cheapest, and most reliable form of solving that problem, and that's what we're here to do.
Excellent. Tamsin, Ben, it's been fascinating for me. Thank you so much for coming onto the show. It's your first time. We would love to have you back in due course to see the performance, to see the work that you're putting through, and hopefully that narrows over time. Thank you all for watching the Vantage series. If there's any other fund or area that you'd love to hear about, let me know. Drop me a line through the inquiries email. And with that, we will say thank you very much.